Hello, and welcome to the Stock and Profit podcast. So, today we're going to be talking about why psychology is more important than technical analysis in Forex trading. Now, Forex trading, of course, is the largest and the most liquid financial market in the world. We all know that. It has attracted, countless traders seeking financial success. While many traders focus on mastering technical analysis, there's a growing realization that psychology plays a more significant role in achieving consistent profitability in the Forex market. Now, today, we will explore why psychology is more important than technical analysis in Forex trading. Now, the first one we're going to consider is emotions and decision making. Now, if you're someone who, it's a veteran, I wouldn't, not necessarily veteran, but if you spend some time in the Forex market trading, you'll realize, and this will resonate with you, that it's not necessarily technical analysis that help you. It's actually your mindset, that you being in control of your emotions, your decision making, right? But let's look at emotions and decision making. Now, one of the most significant reasons psychology trumps technical analysis in Forex trading is the influence of emotions on decision making. Right, so Forex trading can be a roller coaster of emotions. You're winning today, you're losing tomorrow, you're happy now, you're sad later on, and all of that. Now, with wins and losses affecting traders' mental states every now and then. Now, emotions like fear, greed, and impatience often lead to impulsive decisions that can result in significant losses. Technical analysis provides traders with valuable insights into price trends and patterns, but it doesn't address the emotional aspects of trading. Now, traders who fail to manage emotions are more likely to make irrational decisions even if they have a solid technical analysis strategy, and that's the truth. Emotion driven trading can lead to overtrading, revenge trading, and excessive risk taking and leveraging, all of which can erode trading capital. And this is just the reality in trading. You see someone, for example, who your setup, but because there is no emotional control, maybe the last trade was a loss and then you want to revenge trade. And you don't wait for your setup, and then you just take trades and you take trades upon trades that end up has loss. Eventually, when you get your setup, you're simply just making profit to cover all the unnecessary losses you've taken. Now, the second thing is discipline and patience, right? Successful Forex traders require discipline, or they understand discipline and patience, right? So virtues that are close, these virtues, the two virtues of discipline and patience are closely tied to psychological factors. Now, traders must stick to their trading plans and strategies even when the market tests your resolve. Imagine you've taken two losses, back to back, or maybe even three losses, or even 4 or 5 losses. Do you have what it takes to still be disciplined to your trading plan? That is what it means, and that cannot be possible. That's why discipline, and patience is a major ingredient, to your psychology as a Forex trader. Now, psychology helps traders stay disciplined and patient, ensuring they don't deviate from their strategies during tough times, because tough times will come. It helps traders to maintain a long-term perspective and avoid the temptation to chase quick profits. Without the psychological attributes, even the most accurate technical analysis can lead to failure, right? Because at the end of the day, if you're not patient and you're not disciplined enough, you end up taking losses upon losses upon losses, and then when you back test, you see all your setups that could have given you the profit you need, but because you ended up taking a lot of unnecessary losses, it's affecting your psychology, it's affecting your discipline, it's affecting your patience, and at the end of the day, if you're not careful, you'll be left distraught. Now, let's talk about risk management. Now, effective risk management is another crucial element of Forex trading, and it heavily relies on psychological factors. Traders need to determine their risk tolerance and establish appropriate stop loss levels, right? Because there are traders, for example, who trade without stop loss. Okay, now if you're someone who through experience you've been able to develop that, I don't have a problem with that. But for any new person, right, new trader, you're coming into trading, maybe you haven't really gotten that experience where you can say you have a mental stop loss that you stick to, right? Because a lot of people deceive themselves and say they have a mental stop loss, but then when it gets to that stop loss, they say, oh, let me just leave it a little bit more, maybe it's going to reverse, and then that's how they take losses, right? So you need to have a robust risk management in place. Your stop loss is your stop loss. Your stop loss is you saying, if price gets to this point, I'm willing to take a loss and I'm out of the trade. So why do you have to move your stop loss? Okay, that's indiscipline, and that if eventually affects any trader who indulges in that. Now, technical analysis, of course, can help traders to identify potential entry and exit points, and of course stop loss, but it doesn't provide a clear framework for managing risk, right? Because psychology is essential in ensuring that traders stick to your risk management plan and rules, cutting losses when necessary and avoiding reckless trades that can wipe out your account, right? So risk management also has to do with how much you're risking per trade. Are you risking 0.5% of your account, 1%, 2%, 5%, 10%? Depending on where you are at, right, with respect to your journey and how the accuracy of your strike rate, right? So you need to have all of those things in place and stick to them. Okay, now let's talk about adaptability. Now, the forex market is dynamic and subject to constant change. Technical analysis relies on historical dates and patterns, but market conditions can shift unexpectedly. So traders must adapt to changing circumstances, and this requires a flexible and adaptable mindset. Psychology equips traders with the mental agility needed to adjust your strategies and make informed decisions in response to evolving market conditions. Any adaptable trader can remain profitable even when technical analysis signals are less clear, right? So if you're someone who you've learned how to be flexible, right? You don't just marry your bias and say, okay, the market is going to go long, so I'm married to long positions alone. And then the market is clearly showing you that, hey, I'm ready to go short, right? The market is ready to short. And then because of your bias, your long bias, you refuse to be adaptable. You're going to lose a lot of, opportunities, right? Now, lastly, confidence and self-denial. Now, confidence and self-denial are vital for success in forex trading. Technical analysis can provide traders with the knowledge and tools they need, but it's the psychological aspect that enables them to execute trades with confidence, right? For you to be fearless, for you to be not to be hesitant when you see your setup, right? It is, that psychological mindset that has been refined and, really worked on that can help you develop the confidence you need. Now, doubt and insecurity can lead to hesitation and missed opportunities. A trader with a strong psychological foundation is more likely to trust the analysis and take decisive actions. They are also better equipped to handle losses without losing confidence in their abilities, right? In conclusion, now, while technical analysis is undoubtedly a valuable tool in forex trading, as a matter of fact, you start with technical analysis. You can't be talking about psychology if you don't even know technical analysis, right? Because psychology only comes into play when you already know the technicals and you just realize that, okay, something is actually limiting me from going forward. And then you begin to realize that it's not the technicals that you know, it's your psychology that's the limiting factor. And then you come to psychology and you deal with that. Okay, so technical analysis are undoubtedly, without dispute, they're super valuable and actually the foundation for trading. However, it is not the sole determinant of success. The psychological aspect of trading encompasses emotions, discipline, patience, risk management, adaptability, and self-belief. It plays a more significant role in allowing a trader to achieve significant and consistent profitability. So, aspiring traders should prioritize developing their psychological skills alongside their technical analysis, knowledge. Now, without a strong psychological foundation, even the most advanced technical analysis strategies are likely to fall short in the challenging and dynamic world of forex trading. So, in essence, psychology is the cornerstone upon which successful forex trading is built. And if you're ready to level up, why not join the Stock and Profit mentorship program, right? If you've discovered that, hey, it's like it's a ceiling, you're not going above that ceiling, then you need to work on your psychology. Your psychology is the culprit. If you know the technical analysis, you do your back testing, you have the data, and you see that it works, then your psychology is the barrier. And I want to tell you, if you join the Stocking Profit mentorship, if you're not part of the mentorship yet, you'll be able to, go through the program, and eventually all the psychological barriers that have limited your profitability and your progress in the trading in the forex market as a profession will literally be lifted off. And of course, I'll be sharing with you, even we're going to be having one-on-one sessions, and that would really help you to break down those psychological barriers. So hey, that is it on this episode. It's been a pleasure sharing with you. My name is Jonathan Obisi. I'm the founder of Pareto Capital, and see you next time. Stay stuck in profit. Bye.